Bitcoin whales just reversed $14 billion from sell to buy in 72 hours. The last time this exact pattern happened, in 2019, Bitcoin doubled in 90 days. Between October 12th and November 30th, whales dumped 113,070 Bitcoin at prices between $100,000 and $126,000, nearly $10 billion sold at the top. Bitcoin crashed 33% to $83,814. But in the first 6 days of December, those same whales completely flipped. 47,584 Bitcoin accumulated at $83,000 to $86,000. $4.3 billion deployed in less than a week. According to on-chain analysis from Glassnode, whale wallets jumped from 1,350 to over 1,450 active accumulators. Their accumulation trend score hit 0.8, the highest confidence level since early 2023. This is the exact Bitcoin whale accumulation pattern that preceded every major rally since 2019. And I'm going to show you why this time might be different in the best possible way. Here's the problem. Some of those same major whales are running $449 million in short positions. They're literally betting Bitcoin goes down while simultaneously accumulating spot Bitcoin. This creates a market conflict at the $83,000 to $86,000 level. Why you should be skeptical? 449 million in active whale short positions. Retail still buying dips, no full capitulation yet. Order book liquidity collapsed 30% from 20 million to 14 million. No euphoria phase in 2025 like 2017 or 2021 cycles. Global macro uncertainty with Japan signaling rate hikes. On November 30th, Bitcoin dropped 7% in a single day, triggering $600 million in leverage liquidations, the largest since March 2025. In one single hour, $400 million in long positions got margin called out. But here's what separates Bitcoin market bottom signals from dead cat bounces. Whales weren't panic selling during this chaos. According to on-chain data, they were aggressively buying through the liquidation cascade. This is what an inflection point looks like. The market genuinely doesn't know which direction it's heading. Historical cycles show these setups resolve in one of two ways, and right now, 5 critical factors are tilting the scale.
We've seen this exact setup before. In 2019, December 2018, Bitcoin crashed to $3,200. Media declared Bitcoin is dead. Fear and greed index hit extreme fear, exactly where we are now. But in January 2019, something critical happened. The Federal Reserve ended quantitative tightening. They stopped draining money from the financial system. Sound familiar? On December 1st, 2025, the Fed ended QT after 3.5 years. They injected $13.5 billion in overnight repos, the second largest liquidity injection since COVID. The on-chain risk metric in mid-2019 was at 0.6. Today, also 0.6. This metric ranges from 0.0, maximum opportunity, to 1.0, maximum danger. At 0.6, we're in the opportunity building phase. What happened after the 2019 bottom? January 2019, $3,200. June 2019, $13,000, a 306% gain in 6 months. November 2021, $69,000 peak. But here's the critical insight. The recovery wasn't explosive at first. It was boring. For 6 to 9 months, Bitcoin grinded sideways. Constant skepticism, retail apathy, but whales accumulated the entire time. This is called a non-euphoric bottom. No mania phase, no retail FOMO, just institutional money quietly building positions. For 3.5 years, from June 2022 to November 2025, the Federal Reserve drained $2.4 trillion from the financial system. Every month, bonds matured and the Fed didn't reinvest. Money just disappeared from markets. On December 1st, that ended. On December 18th, the Fed is expected to cut rates by 25 basis points with 88.8% probability according to Fed Funds Futures. Why this matters for Bitcoin? Lower rates make zero-yield assets like Bitcoin more attractive. Weakens the dollar, currently down 6 to 7% year over year. Increases risk appetite across all markets. Improves funding conditions for institutional players. This is the exact same macro setup as January 2019. Fed ending QT? Check. Fed cutting rates? Check. Dollar weakening? Check. Whales accumulating? Check. Retail capitulation? Check. On-chain risk at 0.6? Check. The difference, in 2019, Bitcoin had zero institutional infrastructure, no ETFs, no corporate treasuries, no sovereign wealth funds. In 2025, BlackRock's Bitcoin ETF holds $90 billion. MicroStrategy holds 247,000 Bitcoin. Abu Dhabi's sovereign wealth fund tripled holdings in Q3. This isn't speculation anymore, it's institutional reallocation. While traders debate price, something bigger is happening that nobody's paying attention to. Bitcoin merchant adoption just crossed 15,000 companies worldwide, triple the 5,000 in 2022. In August 2025, Sheetz, a 700-location convenience store chain, started accepting Bitcoin with a 50% customer discount. They're using Lightning Network for instant settlement at 80% lower fees than credit cards. Bitcoin payments are projected to grow from $500 to $800 million in 2025 to $3.7 billion by 2031. This is the infrastructure layer being built while everyone focuses on charts. Major retailers like Microsoft, parts of Amazon's ecosystem, and Tesla are integrating Bitcoin payments. When adoption becomes undeniable to mainstream consumers in 2 to 3 years, today's "should I buy at $90,000" debate will look ridiculous. Whales see this 5-year adoption curve. That's why they're accumulating on weakness. Here's your practical playbook based on whale behavior and Bitcoin on-chain analysis. Step 1. Watch the $83,000 to $86,000 defense zone next 2 weeks. This is the critical Bitcoin support level where whales are accumulating. If this holds through the December 18th Fed meeting, it confirms bottom building. If it breaks, we could cascade to $75,000 to $80,000. Monitor weekly. Whale wallet count target continues rising above 1450. Glassnode accumulation trend score target stays above 0.75. Order book depth recovery target back above 18 million. Where to track? Glassnode.com, Santient, CoinGlass. Step 2. Fed December 18th decision equals macro confirmation. Bullish scenario, 88.8% probability. 25 basis point rate cut delivered. Dovish language continues. This equals institutional capital unlock. ETF inflows accelerate. Bearish scenario, 11.2% probability. No cut or hawkish pivot. Market reprices lower. Wait for next accumulation zone. Combined with QT ending on December 1st, this rate cut removes the final monetary headwind suppressing risk assets for over 1,000 days. Action. Wait 48 to 72 hours post-Fed decision before deploying capital. Let volatility settle. Step 3. Dollar cost average into Q1 2026 on-chain risk 0.0 to 0.1 zone. Historically, the on-chain risk metric drops from 0.6 current level to 0.0 to 0.1 before major rallies begin. Expected timeline, January to February 2026. Strategy. Don't lump sum, dollar cost average over 8 to 12 weeks. Think 12 to 24 month time horizon, not 2 to 3 weeks. Target entry range, 75,000 to 90,000, current zone. Position sizing, only deploy capital you can afford to lose.
Example allocation, not financial advice. Week 1 through 4, 25% of total intended capital. Week 5 through 8, 35%, increase if price weakens. Week 9 through 12, 40% final accumulation before expected Q2 2026 rally. If the 2019 pattern holds, we're not looking at an immediate moonshot. We're looking at a 6 to 12 month accumulation window before the real parabolic phase begins in late 2026. Risk management checklist. Diversification. Bitcoin should be 5 to 15% of total portfolio, not 100%. Emergency fund. 6 to 12 months expenses covered before investing. Time horizon. Don't invest money needed within 24 months. Volatility tolerance. Can you stomach another 30 to 40% drawdown? Tax planning. Consult a CPA on short versus long-term capital gains. This is not financial advice. It is pattern recognition based on historical Bitcoin whale accumulation cycles. Whales are thinking generational wealth building over decades. You should too. Markets move through 3 phases: denial, fear, and acceptance. October to November was denial. Bitcoin is going to zero. Right now is fear. Liquidations happening, media doom forecasts, whales quietly accumulating. Q2 to Q3 2026 will be acceptance. Recovery becomes obvious. Retail FOMO drives the final leg. Non-euphoric markets feel boring for 6 to 12 months. That's the signal you're in a bottom building phase, not a top. The $14 billion whale reversal isn't about predicting next week's price. It's about smart money conviction. They're saying the worst is over, the macro setup is shifting, and we're building positions for the 2026 to 2027 cycle. Subscribe and hit the notification bell. Next video, I'm breaking down the exact on-chain metrics to monitor week by week through Q1 2026. We'll track whale behavior, ETF flows, and exchange reserves in real time. Because in Bitcoin, patterns repeat. And right now, the 2019 playbook is unfolding frame by frame. Don't miss it.